Our goal at TaxBridge is for you to be your client's go-to advisor. One of those things clearly is tax strategy, tax planning, and tax questions that your clients have. We collaborate directly with you, the CFP or financial advisor, in order to help you deliver those tax strategies, tax planning, and that value to your client so that you can be their go-to advisor. Thanks for checking out this video. And again, if you have any questions, please reach out to us. This is a recording of one of our webinars at TaxBridge. We did the recording so that you can get a general idea of what one of our webinars might be like. And also we have another recording of one of our coaching calls so that you can get a general idea of what those would be like as well. Both of those are features that you get when you become part of our membership. We have two different tiers. Those are on the website, and I will link the website below so that you can check that out and see the services that we offer. Also, our links to Brian and I's LinkedIn profiles so that you can connect with us there if you have any more information that you want or questions that you have that you want to ask us. All right, so again, this webinar, it's essentially just to introduce ourselves, Brian and I. So Brian would have been with me. He texted me this morning, said he was not feeling well. He said he couldn't sit up for like more than 5 minutes, so he was not able to join us today. But he did co-found TaxBridge with me. He's a friend of mine. We've been friends for about 7 or 8 years now. We both live here in the Orlando area. And again, with this webinar, it is essentially to hopefully deliver value to you and also introduce us and our business TaxBridge. Really what our hope and goal is we want you to be your client's go-to advisor. I know some of you might already be, probably already are, but kind of our idea, people can replace individual people on their team. They can potentially replace their tax person. They can replace their attorney, their insurance person, but their financial advisor is usually the one that they see as having the whole picture. That's usually the person they see that I can't replace my financial advisor because they've got the big picture. They are the ones kind of tying all this together. And we want to help you deliver that specifically as it comes to taxes. And so what our goal is, what we do here is we collaborate directly with you, the CFP or the financial advisor, to provide tax expertise so that you can confidently deliver those tax strategies to your clients. So again, that is our goal, is just to help equip you. Sometimes it's maybe new advisors who don't fully know all the tax strategies. And so they want some ideas, they want some help strategizing for their clients. Sometimes it's financial advisors who have great ideas and they just want someone to bounce that idea off of to make sure that they're not overlooking something and that they have kind of that extra boost in confidence to have another person. A lot of times your client's tax preparer might not be that person. Maybe they either kind of give you the silent treatment or you don't hear back from them, or you want to collaborate with them, but perhaps the mutual client isn't paying the tax preparer for that sort of service. And so they're only getting compliance from them. And so our goal is essentially, again, to go directly to you to help give you that so that you can still deliver the quality of advice and services that you're looking to provide your clients with. Today, we're talking about S corporations. It's a huge topic. It's one that comes up all the time. Clients ask about it all the time. Advisors ask about it all the time. There's some great advice out there. There's some great tips out there. There's also some really bad stuff out there. And so we just want to help break this topic down and give you more information about it. S corporations can save taxes for a lot of your clients, but it's not for everyone. I know that there's some S-Corp marketing out there that essentially makes it sound like the S corporation is going to save everyone taxes in every situation. And honestly, that's just not the case. So we want to go through kind of what's the big draw? Why are people looking at S corporations? Why and how can it save clients time? But then we also want to look at, when is it the right time? How do you identify the clients that this S corporation strategy will work for? And then a quick overview of kind of the step-by-step process. I've got a client that's ready to do the S corporation. How do I help them? How do I walk through this? What are the steps that they're going to need to take to put it in place? And then, as I mentioned, we'll wrap up with some question and answer, as well as just a brief overview of some of the ways we can come alongside and help you at TaxBridge if you're interested in that. Jumping into kind of that first question, Brian and I, we actually set this up as like an interview. So it's essentially a question and then an answer. So I'll just be asking myself the question as if it was posed by you guys. So really that first question I want to cover is, why is switching to an S corporation such a game changer for many small businesses? So the biggest piece here is most of your 95%, maybe more, are switching to S corporations essentially to save taxes, specifically the self employment tax, Social Security, and Medicare taxes. And the reason why the S corporation helps with that is if you have a sole proprietor, or even if you have a partnership, say with two owners, those net income from that business is going to be subject to self-employment tax. So probably all familiar with Schedule C, sole proprietor, income and expenses is going to go on there. Net profit from that business is going to be subject to self-employment tax, which is Social Security, Medicare, and all of it is going to be subject to that. When you make the switch to an S corporation, you essentially get paid in two ways, both with W-2 salary and with owner distributions. That split of how your income from the business is treated is what can generate those tax savings in respect to Social Security and Medicare taxes. So your W-2 is going to be subject to FICA, which is the exact same Social Security and Medicare taxes that the self-employment tax is. And so those W-2 wages, still subject to Social Security Medicare tax, still subject to income tax, nothing there. That's basically a wash. On the other side, the owner distributions. The owner distributions will still be subject to income tax. So this isn't saving any income taxes, but those owner distributions will not be subject to Social Security and Medicare taxes, which are roughly 15%. So anything that can pass through as owner distributions is going to save you about 15% on that. Now you've got the Social Security wage base, which is somewhere around 170 something this year, I think. It was 168, I think, last year, right around there. And so once you get above that Social Security wage base, the savings drops a little bit because you're not saving the full roughly 15% in Social Security Medicare tax. At that point, you're only saving Medicare tax. But a quick example would be a case for a lot of small businesses that you might come across. And again, it's not only applicable to small businesses, but this particular one, if you had a client making about $120,000 in net profit, income minus deductible expenses, net taxable income from that business of $120,000. And let's say that their reasonable salary only needed to be $50,000. That would leave $70,000 of profit not on the W-2 that can be paid as owner distributions that's not going to be subject to Social Security and Medicare taxes. And again, at roughly a 15% tax savings, that's going to generate a little bit more than $10,000 worth of tax savings for that client. Now, qualified business income deduction, the QBI deduction, which is set to expire at the end of this year if Congress doesn't act. I think a lot of people expect that they will. But QBI does affect that calculation and how much tax savings there are. Net profit from a Schedule C, 100% depending on industry and depending on income factors. But generally speaking, the net profit from a Schedule C would be QBI eligible, and you would get to deduct 20% of that as a QBI deduction with some qualifications there. However, when you go to the S corporation, your W-2 income is not QBI eligible. So you're taking a portion of that and removing a potential deduction, which essentially just kind of reduces the tax savings on the S corporation election right now from where it used to be before QBI and where it could be if they do let QBI expire. So just that to say, there are some moving pieces here where it's like, okay, this gap times 15% is a rough ballpark. It's kind of a starting place, but it's not the full analysis that you need to do. Of course, there's also potential state tax implications as well that you might need to look at. But that in general is really the basis behind why most people switch to the S corporation and how it can generate tax savings. So if there's any specific questions on that, the next section, I'm just going to kind of go into how do you identify when is the right time for your clients? But is there anyone who has a quick question? Again, we'll have some questions at the end as well, but any quick questions here kind of on that section of why the S-Corp saves money?
Hey, Brad, maybe you don't want to get into this now or maybe you will later, but I'm always curious on reasonable compensation calculation determination, right? The golden question.
Yeah.
The methodology of how you guys view that and how it adjusts for industry specific, I guess, individual?
That's a great question. We are going to jump into that. So I'll do it when we get there. So how do you know that it's the right time? What are the key signs that it's time for a client to consider becoming an S corporation? You'll see in videos online, you'll see people posting online that, hey, as soon as you have $50,000 of income, then it's time to start looking at S corporation. Or I've seen as soon as you have 100,000, or as soon as you have 150,000. I mean, I've seen all sorts of different income thresholds that people will throw out there to say, if you have this much income, it's time to think about an S corporation. I honestly, I mean, maybe to start the conversation, but it seems like they're saying if you've got this certain amount, then it's going to make sense to make an S corporation, and that's missing a key factor. And so I don't agree with those. I mean, you'll even see people who seem to allude that everyone should be an S corporation. I've seen plenty of clients that come to me with an S corporation that is saving them absolutely nothing. In fact, it's costing them more because the cost of having the S corporation is more than the tax savings that it's generating for them. And so this isn't exactly something that is for everyone. So those thresholds, I would throw those out. The key here is really evaluating, in my opinion, it's evaluating that gap between the reasonable compensation and the net profit. That's what we just talked about, is what's generating the tax savings. So the only way to know if this is an excellent strategy or a useful strategy for your client is to look at, well, what is the gap between the net profit and the reasonable comp? Very easy for you to determine the net profit. You know, that's either an estimate from what's about to happen based on your client's forecasting, or it is what already happened. So it's like, hey, you're looking at a tax return and you see a client that has a Schedule C business and they're making $100,000 net profit on a Schedule C business. Then the question is, okay, maybe an S corporation makes sense, but we need to know what that reasonable compensation is first, because then we can determine what the gap is between what they're making and what reasonable comp is, calculate the tax savings, and decide if it's worth it. So how do you determine reasonable compensation? Well, I always tell people, start with the first word, reasonable. If you just use common sense, you'll be farther ahead than a lot of people out there. I've seen stuff where people come in and, you know, I see, there's one particular one that I like a lot of his stuff, and he's got all the credentials, CPA, attorney, everything. But he talks about paying just 50% as salary and 50% as owner distributions. And the tax court has never used that as one of the valid ways to determine what reasonable compensation is. So I personally would not use that for a client. I would not recommend them to use that. I always tell them, start with what's reasonable. I've seen plenty of S corporations where they're paying zero salary. I can tell you that's not reasonable unless they're actually not doing anything. If it's literally just a passive business where they own it and someone else is running the business, then you could get away with that. But it's reasonable compensation for the services that you're providing to the S corporation. So again, like I just said, if you're completely hands off in this and you've hired someone to manage it and you just are the owner, then sure, you can get away with no compensation. The IRS is horrible at catching this, so it's why people are getting away with it, which is why we have such bad advice out there. The other thing I've seen is a flat just $24,000 a year. Yeah, let's do something. Well, if you're working full time as an attorney and your net business income is 150, then I can guarantee 40 hours plus per week to generate $150,000 as an attorney. No one in their right mind would tell you that reasonable compensation for that attorney is $24,000 a year. They would never go work for someone else at $24,000 a year for full-time work. So that is not reasonable either. So starting just with that term, reasonable, gut check it. Is this reasonable? That's a great place to start. So the next step would be, there's ways where, you can use salary.com. You can use monster.com. You can go online to look for the job that they have and determine what a reasonable rate is for their area. Now, there are factors in this too that are in play. So if you're an attorney on your own generating $150,000 of income, that's a lot different than what an attorney who's in a regional firm generating $3 million worth of billings for that particular law firm is going to be paid as reasonable compensation. So you can factor that in, the size of business, the hours that you work for it. The other thing that you can factor in is the other job duties that you do. This is something that's very critical for small businesses where it's just them, maybe them and one other employee. And that's factoring in all of the things you do for your business. So for instance, if you're operating a law firm on your own, you're not in court and you're not advising clients 100% of your time. You're also potentially doing your own bookkeeping if you just started this business. You're also doing admin work. You might also be doing work that a paralegal in a larger firm might be doing for you. All of those job duties that you're doing have a lower compensation rate than being an attorney. And you can factor that time into your reasonable comp. The tax court has shown that we only have to account for 40 hours a week. So even if you're working 60, 70 hours a week, we only have to base reasonable compensation on 40. And so in that case, what you would do is you would just assign a percentage. So maybe you're working 60 hours a week, but you would assign a percentage. I do 10% admin time. I do 15% paralegal time. I do 10% bookkeeping and other office duties. And I do whatever's left, 60% actual advising clients, attorney work. Well, as you can see, if we only put 60% towards attorney work and all those other job duties have a lower compensation, that's going to bring down your overall compensation, which is going to help increase that gap between compensation and net profit from the business, which is going to help those tax savings. So, of course, you can do this manually. I use a service called RC Reports. That's RC for reasonable comp, reports.com. And I'm actually going to show you what that does and how it helps. I have no affiliate links. I have nothing with them. You can just go directly to their website and buy it if you want to, or lean on a tax person who uses this. But it helps you understand what the court has said is a way. This is a way that this many hats approach is a way that the tax court has used consistently to determine what reasonable compensation should be. So this particular, it's just a test client. Basically, you set up the client in RC Reports, and then you tell it, hey, I have a new report that I need to do. It's for this client. It is tax compliance for an S corporation. Their C corporations or other things. I really only use this for S corporation clients. That's all that I particularly have right now at this point. There are 3 different approaches. These are all approaches that the tax court has used. The most common you're going to see with the small business owner is going to be that cost approach or the many hats approach. I haven't even actually used these other 2 in RC Reports for any of my clients. We're going to select the tax year. It's 2025. Yes, I want to display the report. I don't need it to notify me. So then we're going to, you can send this interview to a client. I found when I send the interview to the client, it doesn't really go that well. They get into it and they're like, I don't know what I'm doing. And I was like, okay, so I'll do it for them. So here again, you can set their hours. Maybe they're part-time and only working 20 hours in this S corporation, but they have another W-2 job or something, or they're working somewhere else, or maybe they're a consultant and they're only working 20 hours a week. Then that, of course, would factor into this reasonable compensation. The other thing you can do is you can always just set it to 40, and if they're working 20 hours a week, take half of whatever the reasonable compensation is. I mean, that's the only thing that this particular piece is going to calculate. You'll choose where they're at. I'm just going to choose Florida since that's where I am. And you choose what county they're in. And again, this is going to be to help determine the wages for that specific location, since we all know cost of living adjustments and everything affects wages. Then essentially what you do is you need to understand and help your client understand. So this is what I do. I usually do this for them, but I ask them, hey, what do you do in a typical week? And your client is always going to say every week is different. And I say, I know, but on average throughout the year, just give me a good breakdown. Again, we're not trying to dial this reasonable compensation in to the dollar or to the penny. We're trying to get a good ballpark so that we have something defensible if you have to go through a reasonable compensation audit. So again, perhaps they are the office clerk. Maybe they're the receptionist and the customer service rep and the file clerk. Office clerk kind of covers all of those. So we don't have to go into a lot of detail here. Maybe they also are the sales rep. They're the ones taking calls and closing clients. Maybe they also do a little bit of bookkeeping work. You could kind of keep that in office clerk too, or put it here. And okay, that's it for them. Then you actually choose their specific job. So we would say attorney for this example. And then we would go to proficiency and time spent on each one of these tasks. So I always tell my clients, when you're talking to your client, of course, you're the best attorney in the world. But when you're doing your reasonable compensation, how much experience do you have? Are you actually above average? Are you new? Is this your first year? Maybe you're a little bit below average. With reasonable compensation, we want to be honest with those things. And so maybe they're an average office clerk. They're an average sales rep. They're an attorney, so they're probably a below average bookkeeper. And maybe they've got a decent amount of experience, so they are above average in terms of their work as an attorney. Then we set the time, so they might spend 13% of their time on this, 15 on this, 4 on this, and the rest on actually being an attorney. Then what it does is it puts together the report for you, and it takes the amount of time that they're spending. Again, we got full time, and then we've got the percentages of that time that we've assigned to each of these job duties. And it's going to say, hey, based on all this, we think your reasonable comp should be 150. This is actually the highest reasonable comp I've ever seen. I didn't run this example before. I haven't seen it come out this high before, but it's probably because we stuck a ton of their time towards attorney and not much time towards the other things. And I currently don't have any attorney clients, so I haven't seen one come out this high. But then it gives you, here's what it is. Here's the reasonable comp. Here's the breakdown. This is for full time, 2,080 hours per year in Orange County, Florida. Then it's going to go through, here's the things that you did. Here's the hourly wage for each one of those job duties times the amount of time you told us you spent on it. And that's what essentially adds up to your reasonable comp. Then it gives you, hey, here's how the courts have done it. It gives you links to click on, court cases to look at, the ways that they have said that this is a valid method. And essentially what I do is I stick this in the file. This goes in the file for the client. If we ever get a reasonable compensation audit, this is what we're going to pull out. We're going to hand to the IRS agent because, like I said, the majority of people out there, they are pulling numbers out of thin air. And they're making up low numbers. And so this should be sufficient. I tell clients a lot of times too, hey, maybe this says 70,000. The IRS one day audits you and challenges this and says it should be 80. Well, one, handing this to them saying, well, we actually put some research into this. We put some thought into this and we've got data to back it up. Then we probably win that and it stands at 70. Even if we lose, okay, they bump us from 70 to 80. Well, that's better than the advisor who told you to do 20, and now you're paying penalties and taxes on an extra 50,000 of wages. Because that's what will happen. If reasonable comp is too low and the IRS audits you and determines that it's too low, they will recharacterize owner distributions as reasonable compensation, charge you the Social Security, Medicare, payroll taxes, as well as penalties and interest over the years that you didn't pay those, depending on how long it's been before they catch you. And the downside of that is they don't catch you very fast. They'll wait, catch you 5 years from now, and then go back and look at all of the last 3 years. So the other thing I do when I hand this to clients is I say, gut check this too. I had one where the guy was fund development. It came out at like 70,000. He was like, that's too low. He's like, I think it really should be around 120. And so we put his at 120, but we've still got this in the file. And we made some adjustments and we made some notes as to why we adjusted it. And then we stuck that in the file. So that's a great way. The other thing that you're balancing here, S corporations. So if you set up a retirement plan for your client, a SEP or a 401k, the percentages that you can contribute to those, the matching percentages or the employer percentages are going to be based on that net profit from the Schedule C. When you make the switch to S corporation, those percentages are all going to be based on the W-2 salary. So if you take a $150,000 Schedule C and you turn it into $70,000 of W-2 salary, you just reduce the amount of money that you can put into one of those retirement plans. So that's another balance that you might want to talk to with clients about. If they just want to put $10,000 away into a simple or a solo 401k or something, fine, whatever. But if they're like, hey, I want to put away the maximum amount I can every year in retirement, this might limit that. So you've got to balance those things out. So again, another way that you might determine that the S corporation isn't exactly the route your client wants to go based on those other priorities that they might have. Other things to consider are administrative costs. So the S corporation, when they go from Schedule C to S corporation, it's going to cost more. They're going to have to set up payroll. If they don't already have employees, now they have to set up payroll and either pay someone to run the payroll for them or do it themselves on something like Augusto or ADP or something. So they've got some extra costs there. The tax return, the S corporation tax return, is going to cost them more than putting it on a Schedule C on the personal tax return. They have maybe some state-specific tax issues that they have to deal with. Not every state accepts an S corporation election, so that's kind of another factor you got to look into. If they make an S corporation election federally, their state might not accept that, so they might be treated as a C corporation at the state level. The other things are additional administrative duties that they have to do. So when you're a Schedule C business, you can just track your mileage and stick the mileage on the tax return. You can stick your home office on the tax return and just take a deduction for those things if you qualify for them. But as soon as you make that S corporation election, you don't have to do actual reimbursements. You need to submit a reimbursement expense form to your company and reimburse yourself. The cash should flow out. Now, I've seen people who will make journal entries for those, and I've done it in the past when we need to, but that's not the way you really want to do it. You want to have an accountable plan in place. You want to have a business expense reimbursement policy in place, and you want to be submitting reimbursement forms essentially as if, all right, some people are like, if you work for Walmart, well, one, they wouldn't let you be swiping the Walmart card for your groceries, so stop doing that. Clients do that all the time. We've seen it all the time where they're spending personal money on the business card. And then the other thing is, well, if you spend a business expense or you travel, they're not going to just send you the money. They're not going to just let you forget it. You're going to have to submit a reimbursement form. So you need to treat this as a separate entity. Even you need to do that with not the reimbursement piece, but you need to treat it respectively as a separate business when it's a Schedule C as well, but it becomes more important when you make that S corporation election. And so I've had clients before who are like, okay, I know it's going to save me. I mean, I had one, it was going to save him something like $15,000 to $20,000. And he was like, I just don't want to deal with it. I still want to be a Schedule C. And I was like, that's fine. I've given you the data. It's not my decision to make. I would probably make it for $15,000 or $20,000, but he was making about $500. He really didn't care. He was like, whatever. So I was like, fine, it's your decision to make. He decided not to do it because of those. So that's where I think, it's our job as advisors, of course, to give them all the data so that they can decide what their priorities are and what's worth it to them or not. This is just a very simple Excel tool that I created myself. I have an S corporation comparison tool within my tax program that I can run, and I would use that for more complex situations. But this is just kind of a starting point. Doesn't cover nearly everything. It's very basic, but it does help to kind of show how to think through if this makes sense or not for clients. So I'll go through that real quick and then I'll pause again for some questions. So again, this is going to essentially just show the evaluation between how much taxes is it going to save because of the reasonable compensation versus net income, and then is it enough to cover the extra cost of switching to an S corporation. So in this particular example, it's a married couple where only one spouse is working, and the only income we're looking at is this self-employment income. Should it be a Schedule C? Should it be an S-Corp? So if net income, so we're taking a standard deduction. We're saying it is QBI eligible. They have no other income. The net income from the business is $150,000. The reasonable compensation is $80,000. Then we just need to put in kind of their average tax rate. Based on their taxable income right here of $90,101, the average tax rate for those are going to be 11.5 and 12.3. So I plugged those in. And essentially it calculates the QBI, it calculates the federal income tax, and this is only looking at federal. And it's essentially saying that for this particular situation, on your federal, it's going to save you about $6,620 in taxes. But the S-Corp tax return might cost you $1,200 instead of whatever the Schedule C was going to be. Maybe you have to pay $80 a month to get payroll through ADP. And maybe because it's not a Schedule C anymore, I require all my S corporations to use some sort of accounting software. So maybe now you've got to get QuickBooks and start using accounting software where you weren't before. So all of that is going to increase costs that are specifically related to this S corporation, and that's going to drive down the tax savings. So that's where I would then talk to the client and say, hey, look, here's kind of the picture. Is it worth $3,700 to you or not? And then, they would decide. And so it helps quantify that. And that is really what you want to be thinking through is it saving enough to make this jump? And you can quickly see if reasonable comp has to be 140, then because of the extra cost, it's actually going to cost you more to make this switch than it would to stay on Schedule C. So that just goes to show that it's not perfect for everybody. So I'll pause there again for questions. Where we're about to go is we'll go through a brief overview of the steps to actually make the S-Corp election. Then we'll go into a bigger time of question and answers. But Again, pausing right here for anything in terms of reasonable compensation, savings, or how to know the right time to make that switch. So going through that, you might have clients who are on Schedule C and they're just flat out sole proprietors. You might have some that already have an LLC set up, but they've never made the election to be treated as an S corporation. So they are still a sole proprietor, even though they have an LLC. The first step you have to do is you have to create some sort of entity. As an individual sole proprietor operating under your own name, you cannot make an S-Corp election. You have to have some sort of legal entity. The most common is LLC. You can also set up a corporation and then make an S-Corporation election. So you either set up an LLC or a corporation, and then you would file Form 2553 with the IRS for that entity to elect to be treated as an S-Corporation. So kind of touching on that for a minute, LLCs don't exist for tax purposes. If you set up an LLC, it means absolutely nothing for taxes. If you have a one-owner LLC, by default, it's a disregarded entity as if it doesn't exist and you're a sole proprietor for tax purposes. If you have a more than one owner LLC, by default, you're treated as a partnership and you would file a partnership tax return. So the LLC does nothing for you in terms of taxes. It doesn't open up new tax deductions. It doesn't do anything for you that you couldn't do without it. The only thing it really does is, one, it can allow you now to make the S-Corp election. So if you want to be an S-Corporation, that could be the first step that you need to do. The second thing it does has nothing to do with taxes. It's asset protection. And I can't give you any information on that. You would have to talk to an attorney about what sort of liability and asset protection that an LLC could give you. So you set up the LLC or the corporation, then you elect S corporation status with the IRS with Form 2553. A lot of states, that's all you have to do. Some states, you have to make a separate election with them. And as I mentioned before, some states don't recognize the S election at all. So you need to figure that piece out. The next thing you would want to do is you'd want to determine, hopefully you've already determined what reasonable comp needs to be before this point, because that was a big factor in deciding if this was actually the right step to take or not. So now you have to set up payroll. If they already have employees, you just add them onto payroll. If they don't, you've got to get payroll set up, get your state unemployment, state withholding, all those things set up, and start running payroll to the owner for reasonable compensation. Then you want to just help make sure that they're maintaining compliance, both with their payroll, reports are getting filed, W-2s are getting done, payroll is getting done correctly. S corporations have, they can't have more than 100 shareholders. They can't have specific types of entities that are owners of S corporations. So you want to make sure that they're compliant there. Again, most of the clients I deal with are one owner S corporations, so they don't really have to deal with those sorts of things. S corporation owner distributions, if you do have where there's multiple owners, the distributions have to be equal to their ownership. So in a partnership, if you have 50-50 partners, they can take partnership distributions at different times and different amounts. They don't necessarily have to be in relation to their ownership percentage, and it's tracked through their capital account. With an S corporation, it's tracked similarly, but if you don't make the distribution, so if we're 50-50 and I take $5,000 out as an owner distribution and you take nothing out, we just invalidated our S election. If we're 50-50 and I take 5, you have to take 5 as well. Now, there are some parameters for fixing this within a reasonable amount of time if the client didn't know any better and they did it wrong, but you've always got to make those at the same time according to their ownership percentages. That's one of the biggest pieces of S corporations that will invalidate it. The other thing that can actually invalidate an S corp election, I don't know how frequently it happens, but I have seen it happen, not personally, but I've read court case on it, is your operating agreement. That's assuming your client has an operating agreement and they didn't just go to the Secretary of State, set up their own LLC, never consulted an attorney. The vast majority I see, they did it themselves. They don't even have an operating agreement. But if they have an operating agreement, and if they have a standard typical LLC operating agreement, it's going to have partnership language in it, probably by default, which is going to talk about subchapter K, and it's going to talk about owner distributions, and it's not going to say that the owner distributions are according to ownership percentage. And that can actually invalidate the S election. Now, the particular case that I saw, basically, they told the IRS, they're like, hey, we didn't know any better. And they let them amend the operating agreement and fixed it. And so it didn't actually invalidate, they let them keep being an S corporation. So it was a simple fix, but having that language in there to begin with. So, if you're talking to an attorney, setting up an operating agreement, look, it's going to be an S corporation. We need to make sure that the owner distributions are in alignment with the S corporation requirements. And then that's pretty much it for, how to go about kind of setting the S corporation in place and what you need to pay attention to. So again, we'll go into just a period of question and answers. This can be related to what we've discussed, anything that you want clarification on, anything that maybe we didn't discuss that you have questions about, or, fine too, if you have a specific client that you have questions about, we can answer some questions there too. So we'll do that. And then we'll just wrap it up real briefly at the end with a little bit of a summary over the services we provide and what you could expect to get from us in terms of those services.
Could you explain a little bit more in regards to what you're talking about with like the reimbursement? Would those things not just run through the business instead? I'm not sure I understood what that.
Yeah, that's a great question. So ideally, all business expenses should run through the business. Now, mileage can't necessarily run through the business because it's not actually a cash cost, right? So what you would need to do is you need to keep your mileage log just like you would anyway, but then you need to take the mileage, multiply it times the standard mileage rate, and actually reimburse that from the business. So in order to do that, you'd fill out the mileage reimbursement form like you would for another company. Say I drove 1,000 miles at 65 cents a mile with $650. Sign that, stick it in your file with your other receipts, and then just transfer that money from the S corporation to your personal as a reimbursement, $650. And then in your accounting software, that's not an owner distribution, that's a business expense, and you would categorize that business expense to automobile mileage reimbursement, auto expense, whatever. Same thing with the home office. Home office isn't actually a cash expense. You would need to use the percentage method where you take, hey, my office is 100 square feet. My whole house is 1,000. That's 10%. So 10% of my mortgage interest, 10% of my property taxes, 10% of my homeowner's insurance, 10% of my utilities. This is what the home office expense is. Submit that as reimbursement. Transfer that amount of money from business to personal and reimburse yourself for that. Anything else essentially would be a cash expense that, just go ahead and put it on the company card. If you happen to pull out the wrong card, personal card for a business expense, you would need to do a reimbursement in the same way to get that money into the business. Whereas again, on a Schedule C, because the Schedule C and you are the same, it really doesn't matter. I prefer people put it in the business to keep things clean. It helps them out, helps everybody out. But they don't have to do that step with a Schedule C. They can just put the expense straight in Schedule C. But you can't put an expense from your personal credit card on the S corporation tax return. Again, some people will do this to a journal entry. They'll essentially make the journal entry to put the expense on the S corp, and the offsetting entry would be to reduce owner distributions or to say capital contributed to the S corporation. But I think upon audit, if you were audited, they would remove those because the S corporation didn't actually spend the money and you don't have a reimbursement policy in place. They're not going to allow that. One person did ask about the worksheet. I will send the worksheet out to you guys. You can use it. I make no sort of promise on that. Use at your own risk completely. But I will send that out to you all for joining the webinar today. The other question, someone said, can you talk about the pass-through entity tax and its credit? I might not understand that question completely. S corporations are pass-through entities, so the S corporation pays no income tax itself, similar to a partnership. It would have an S corporation would have a K1. The net business profit from that K1 would go onto the client's personal tax return, and they would pay the income taxes there at that level. In terms of a credit, I'm not sure. I mean, that net income would still be open and subject to QBI deduction if it's eligible for that, and you're within the income limits. So what I'll do real quick is I'll just kind of run through what we offer, some of the things that we would provide to you if you were part of our membership group, and I'll just cover those real quick, and then we'll open it back up in case someone thinks of another question between now and then. One other thing I will mention, no one has asked about it, but unfortunately we're not set up to provide CE. We are looking into that in the future though. So hopefully maybe down the line, if it's not too many hoops to jump through, we can get approved to provide CE for a CFP license if anyone would benefit from that. I don't think we're going to jump through the hoops of going through NASBA for CPA, CPE requirements, but since our main target is CFP and other financial advisors anyway, we will look into that piece and hopefully be able to do that. So in terms of working with us, we do have 2 different membership options, and I'll just kind of put those up here on the screen real quick. So we have kind of an essential and a premium. In the essential, what we would do is we would give you access to educational content on tax strategies. And we're also putting together, I know a lot of financial advisors are, hey, I need someone to actually prepare my client's tax return. And so one of the things is, I mean, I get those requests all the time for the financial advisors I have. Brian does too. Both of our personal practices right now in terms of tax prep are taking new clients, but not at a high volume. We're essentially both kind of managing growth pretty specifically right now. But one thing we want to do is we want to put together kind of a curated list where hopefully this would save you a ton of time because, hey, maybe I haven't reviewed their tax returns or anything like that, but I've sat down, I've had a conversation with these people. They're normal people. I've met them. I know them either over the time or I've met them recently and at least vetted them a little bit to some extent to help you save a little bit of time. Because I know a lot of times you're spending a ton of time just meeting new tax preparers to see, is this someone that I can send my clients to? And so essentially we hope we're going to get that list to where here's the person. Yes, they're open to taking clients and here's the type of client they want. And then you could connect with them from there. So again, there's still, of course, some stuff you got to do there with connecting, but that should hopefully save a ton of time from trying to find and reach out to preparers, not even knowing if they're taking new clients, not even knowing what type of clients they want. And so that'll hopefully be a good resource. We'll create a private LinkedIn group. This would essentially just be a place where, there's dialogue, there's question and answers there. You guys are networking with each other there. We're helping answer questions. We're growing together there with sharing strategy and everything. Then we'll have a monthly webinar like this where we cover different topics and we'll reach out to members at that point to see kind of what topics are top priority and what we should cover. And again, hopefully one day those might be CE approved and be able to get continuing ed credit for those. And then you also get 2 tax return reviews per year. And so what we would do there is you would actually submit a client's tax return to us and we would go through it. We would provide a Loom video and a short presentation. I'll show you an example of the presentation in just a second. But you would submit that return to us. You would submit your client kind of overview, their top questions, maybe your top questions. And then, what do you want? Are we trying to help you come up with strategy? Do you have some strategies that you want a second opinion on? We would go through that return. We would essentially look for any kind of errors or mistakes in the return. We would look for opportunities for tax savings. And we would kind of just give our general feedback and overview of the client in terms of, what's in that report and that video. So the report would essentially look like this. This is one that I did for a financial planner recently where this particular client had an S-Corporation and their personal tax return. They submitted that. That counts as one submission. This particular one didn't really have much in terms of tax strategy. This one actually ended up being more about the viability of their business. I went through the tax return for the business. This particular one, they'd been in business a long time, about 30 years. They had $1 million in revenue, but they were losing money. There were a couple of different owners. They had, here's a highlight of the key expenses. Their cash was low compared to their monthly expenses. They didn't have much cash on hand. They had a ton of shareholder loans. In fact, the shareholder loans is what was funding the business to be able to turn around and pay them salary. They had a net loss in the business. Their salaries were there and the money they put into the company. So essentially they were taking their own money, putting it into the company and kind of paying it back out to themselves as salary. So they were generating taxable income for themselves out of money they'd already paid tax on. So that was pretty bad. You kind of see that a lot though. Again, business tax considerations. Hey, here's some potential write-offs, some W-2 concerns that I had, what I just mentioned to you guys. There were some shareholder basis concerns as well. Then on the personal tax return, just a quick kind of overview there. Their federal withholding was way too high, kind of pointed that out. State withholding was way too high as well. Made a recommendation here in terms of changing the withholding to improve cash flow. This particular client essentially was pulling money from brokerage accounts. So they had a good amount of brokerage accounts. Taxable income was really low. So I actually mentioned the possibility of doing some tax gain harvesting in this particular situation. Also, they weren't, putting any money, I don't think, into 401k. but again, they were losing money on the business. So that was just something to think through. They didn't have a health savings account. Maybe I don't know their health plan, so I didn't know if they were eligible for one or not, but I brought that up. And then key questions, kind of tax strategy, personal finances, business structure. Does it make sense to still be an S corporation? The biggest one for this particular client was business viability. You probably need to go back to this client and kind of figure out, was this a one-off year? Based on the retained earnings of this business, it didn't look like a one-off year. It looked like it had been losing money for at least some time. Owner loans from the owner to the business were north of $900,000. So, I mean, honestly, this one just needed to sit down and talk about, does it make sense to still have this business? One of the other things we have 2-page tax summary documents. So like this one is on the business use of your home. This would be something that would be available to you to download, use for yourself, or to send out to a client, where it's just a quick 2-page overview of business use of the home. Another one, business entity pros and cons, goes through the pros, cons, and if it's a good fit for the different business entities. So these are just 2-page documents that essentially we've got about 60 of these that would be available to you as well. So in the premium, you get, of course, everything that's in the essential, except instead of 2 tax returns per year, you would get 4, so 1 per quarter. You could submit those tax returns to us. Again, you get that summary report that I just showed you and a Loom video of us just going through the return. So, summary report, kind of look through that. Loom video would, of course, have all the details as we're just kind of walking through and sharing with you what we see in the tax return. You also would have the option to join. You'd have available to you office hours. So we're going to have 2 different days per month. Brian will take one, I'll take one, 1-hour office hour. So as opposed to the webinar where we're kind of presenting a topic, those will still have plenty of time for question and answer. But this office hour, it's more of a small group. We're going to limit those to 12 people per office hour on just as you schedule them, as you need them. You could join the office hours. And that's going to be more kind of strategizing, just bring your questions. And then in the group, we'll discuss those and we'll talk through those. We'll give our input on that. And so it's kind of like that tax return review, but on a more frequent basis, you can join in those office hours and get questions answered, whether it's in general tax questions or specific questions about specific client situations that you have would be in those office hours. And this also opens up the ability, if you say, hey, 4 tax returns per year isn't enough for me, then you would have the option of basically paying per review. If you needed, hey, I need 2, I got my 4 this year, I need 2 more, then you could pay per review to get extra tax return reviews. Also, this one, for an extra $200 a month, we would actually provide support if you get pushback on a strategy from one of your client's tax preparers. So again, maybe you're giving tax strategy, you're bouncing things off of us, we're in agreement with you, we've worked together, collaborated with you, and then like, hey, the preparer doesn't want to do it. Like they're giving some pushback. We could actually hop on a phone call, and we're limiting this to two per month, I think. We'll hop on the call and we'll walk through it with them, tax expert to tax expert. Hey, here's what we talked about. Here's what we did. What's your hesitation? What do you have issues with? And we'll, do the best we can to kind of help navigate that and get everyone on the same page. Again, the idea there is essentially mostly saving you time to where you don't have to be the one kind of handling that when the client comes back to you and says, hey, my tax preparer doesn't think this is a good idea, or they just didn't do it for some reason, or they handled it wrong. Then we would, we'd be able to help do that. That's essentially kind of what's in our different options, and what would be available if you collaborate with us. So again, going back, a few minutes left for any questions about S corporations or any questions about the services that we offer. So, I do have a question here about running payroll. So I have seen people do payroll one time in December. I've also seen people do a late election, and they'll take the S-Corp election all the way back to January. So there is a revenue procedure that allows late S-Corporation elections. A lot of the ones that are done probably don't actually meet the qualifications to do that. In order to make a late, this is separate from the question, but in order to make a late S-Corp election, you have to have intended to be an S-Corporation and been operating as an S-Corporation. Ideally, they're doing payroll throughout the year. I haven't seen it be an issue, and certainly if you're fixing something, it's better than nothing to do the payroll at the end of the year and get it done and get it squared away. I have a few clients where I run payroll quarterly. So most of my S corporations, I advise them and I hope that we can run it monthly. So we'll run it monthly every month. If, I've got several that are real estate agents and they don't want to run it monthly because their income's up and down and they're not sure. And so I tell them, look, just take your owner distributions whenever you need them. And then each quarter I run a payroll to recharacterize some of the owner distributions as salary. And essentially it's a net zero paycheck where we run a salary for $5,000, the taxes are withheld, and then whatever the net paycheck would be, I zero out against the owner distributions that they already took. And that essentially recharacterizes some of those owner distributions as salary. So you could do that at the end of December. One issue you could run into, you'd have to get checked by the IRS for them to have an issue. And I don't know if they would have an issue. I haven't seen any cases on this or not. But, W-2 withholding is usually throughout the year. And so they might not like the fact that you didn't pay any taxes in until the end of the year, even though you were making money throughout the year, which would be similar to the same issue you would have if you didn't make estimated tax payments and you just paid it all in at tax time. They want it throughout the year. So you could run into that issue. I haven't personally seen it. Don't know if it would be an issue. I recommend at least doing payroll quarterly, because then at least, you've gotten it in on those quarterly timeframes.
Right. Just one quick add-on there. So on the margin, why would monthly be better than quarterly?
Yeah, that's a good question. So I don't know that it would be better.
So quarterly, meets the standard of throughout the year also.
Yeah. And again, think about it. If they were self-employed and they had to make estimated tax payments, those would only be on a quarterly basis as well. Now, typically, paychecks are every other week or twice a month. But, another reason would be some states require. So in Florida, there's no requirement for how frequently you have to pay employees. I can pay my employees once a year and the state says nothing about it. Now, I probably wouldn't have very many employees if I did that. But some states actually, I think South Carolina is one where they require you to pay at least biweekly. So you could have some of that. Now, again, I don't know at the state level if you'd run into a problem, if they would see that you're only running payroll quarterly and say something. Because, of course, if you're a one-owner S corporation, you're not going to report yourself to the state and say that you're not paying yourself frequently enough. So I don't know the risks there, but some states do have, and maybe they have exceptions for that if it's like a one owner or something.
Yeah, that's helpful. Thank you very much.
And if you're interested in our services, just reach out to us. You can send an email either to info@taxbridgeadvisor.com. Check out our website, taxbridgeadvisor.com. I'll send the recording of this out to you as well so that you have it. I'll also send that S-Corp comparison tool to you. And yeah, connect with me on LinkedIn. If you have any questions, shoot me a message, shoot me an email. If you're interested in our services, let me know. Appreciate you guys all joining.